This is the L2 Capital Podcast with hedge fund manager Marcelo López. The L2 Capital Podcast focuses on potential opportunities in the market and brings to your industry leaders and an intelligent conversation about their respective areas of expertise. And now, here's your host, Marcelo López.
Hello everyone and welcome to the L2 Capital Podcast. I have the pleasure to talk today to Vimal Gor, Head of Bond, Income and Defensive Strategies at Pendel Group. I attended a conference at the beginning of May and Vimal was one of the speakers. He was actually, in my opinion, the best speaker of the day, so I had to stop him on his way out to ask him to come to this podcast, and he very kindly agreed to do so. So Vimal, welcome to this program. It's a pleasure to have you here and talk to you again.
Thank you, and it's a pleasure to be here. I really appreciate the opportunity to speak today.
Thank you. Vimal, could you please tell us a little bit about the Pendel Group?
Yeah, thank you. Pendel Group is an independent asset manager. We're separately listed on the Australian Stock Exchange, and we run about $100 billion of assets. Generally, the Pendel Group focuses, we own Hambro in the UK, J.O. Hambro Capital Management, and there's about 50 billion run out of there and about 50 billion run out of Pendel Australia. My team, which is the Bond, Income and Defensive Strategies team, employs about 15 full-time investment professionals and run about $20 billion. And we run them across cash, aggregate strategies, everything through to hedge funds. And we also have a multi-asset long volatility fund, which we launched recently.
Awesome. Well, you mentioned in your speech and also in an article that was released in the Financial Review soon after your speech, something very interesting, the illusion of liquidity. With apparently so much money in the system today, would you care to explain to us what you mean by that?
I think this illusion of liquidity works on so many different levels right now. As you mentioned, there is massive amounts of money that's been pumped into the system really since the GFC via numerous quantitative easing programs that have been conducted by various central banks across the world. But when you look through the markets, you can see pockets of illiquidity popping up at all points. For example, we had the flash crash in the Japanese yen earlier this year, where it moved materially in one day and then bounced back. You can look at the equity markets where about 50% of the volume is done in the last hour of trading, which is all around algorithmic accounts. You can look at the disappearing of liquidity that happens around economic numbers as the algos pull back. And then you can look at the problems you're seeing across cross-currency basis and even in the front end of the US now, problems with the plumbing of the system, which are indicative of a shortage of, for example, right now, a shortage of dollars. So while at the surface, the markets look to be very liquid and be functioning very well, all you need to do is just go slightly down one level and you can see all of these issues around liquidity that are popping up. And the key one for us right now is this illusion of liquidity in the US money markets. And when you're beginning to see these plumbing problems push up, and they're indicating quite clearly a shortage of dollars. And that's really to do with the fact that the Fed is still tightening policy. Even though they've indicated they'll be cutting rates and policy is likely to be eased at the end of this month and materially over the next couple of years, you've got to remember the Fed is still tightening policy by conducting its quantitative tightening policy, which is going to run until September. So not only are we talking about shifting to an easing cycle, but we're currently in a tightening cycle, and that's having all sorts of ramifications right now.
Interesting. So I've got a couple of questions for you. The yield curve is flattening, and in some parts of the curve there is already an inversion. And normally an inversion of the yield curve means a recession is on the horizon. Do you see a recession happening in the US? And what will be the impact of this yield curve flattening or inverting for emerging markets and high yield bonds?
You're right. We've seen a material flattening of the yield curve in the US, and we've seen it inverted in numerous parts throughout the curve now, specifically in the front end, where you've got very large expectations of rate hikes coming through in the short dated part of the curve. It's normal for the yield curve to flatten as it believes the Fed is over tightened. And that's because the Fed controls the front end of the curve, but the back end of the curve is controlled by supply and demand, i.e. the ebb and flow of market participants. And they've been pushing bond yields lower. And so current 10-year bond yields just around 2%. Now, it's normal now and for the Fed to start cutting rates and the yield curve to start steepening. And what's really interesting is you're already beginning to see that. If you look at the dynamics of the curve, what's happening is the spot curve continues to flatten, but the forward curve is steepening. And that's a dynamic you often see at the end of a cycle, when just before the Fed starts cutting, and you're beginning to see things like 2s, 5, 6 month forwards and 1s, 2s, 2 year forward, all of these kind of forward expressions beginning to steepen up now. And that happens just before rate cutting cycle. My personal view is the Fed is over tightened. The belief is that because the Fed was coming from 0 and they've hiked rates up to 2.5%, that increment isn't too large. But you've got to remember the size of the quantitative easing packages that we saw in the US. Effectively, the US was running large negative real interest rates. And the shadow, I think it was the Atlanta Fed, have a shadow rate, and that was down about 3.5% negative. And so you can say, well, the Fed's hiked rates by nearly 6% in a short period, 2016 to now. And that rate of change has enough to slow the economy. And you could see all the interest rate sensitive parts of the economy slowing. So you've had that as the first part. You've had the rate of change of Fed funds and the monetary policy in the US tightening a lot. At the same time as you've had a large amount of credit that's been issued into the system. And so you've got this problem where Fed funds have been tightening, monetary policy has been tightening, interest rate sensitive sectors have been slowing, and then you've got coupled with a trade war. And so now you've got this slowing of the economy, which I worry is actually embedded in the US. And all the forward-looking indicators I'm looking at tell me the US should continue to slow from here. And people look and say, well, okay, unemployment rate is low and the wages are picking up, but that's late cycle phenomenon. You always see those in the US. You always see the unemployment rate pick at the lowest before you enter recessions, and you will see wages largely the highest before you enter recessions because they're lagging indicators. So I look at it now and say I think there's a very strong chance if the US isn't in recession now, it's going to be there soon. And secondly, the implications of that is that a slowing global growth environment, I think, is upon us. With the US slowing, all the data we've seen out of Asia has been weak. We saw the growth numbers out of China yesterday were the weakest for something over 20 years. And we know that all the data in Europe is weak. So I don't see there being any growth engines of the world right now. And that has to have an impact on, one, emerging markets, as you mentioned, but two, given the size of the credit issuance we've seen number of years and the big bubble that's been built up in credit securities, I'd expect that to impact credit securities as the US continues to slow and corporate balance sheets become to get a little bit more stressed.
Interesting. Do you think the US and the rest of the developed world will follow the same path as Japan?
I think we largely have. And the reason for that is the demographics. So a large part of what's happening in the US now has been due to the baby boomers and the demographic path the US is following. And ultimately, we can look at it and say, well, bond yields have been declining for a 40-year period now. Debt levels have been going up for not for the same amount of time, but materially over the last 10 or 20 years. And we're reaching a situation where the economy does look similar to Japan. Now, Japan is conducting its own rectification of the system and remedy of the situation, which is effectively stealth MMT. And at the end of this cycle, when the US clearly has entered recession, the Fed responds to that and exhausts its limited room to cut monetary policy, which is only 2.5%. Well, then at some point you would expect MMT and fiscal policy to come much more into the fore and the baton to be passed from monetary to fiscal.
Interesting. Well, you just answered my next question, but I know you have spoken to Bill Mitchell recently, so I have to ask you this. MMT is really coming, and if so, how do we need to think about it?
We had I hosted a session with Bill Mitchell in our office just a couple of weeks ago, which is incredibly illuminating. I'm in no doubt that MMT is coming, really because the monetary policy lever across the whole world is largely exhausted. So you look at Japan and you look at Europe now, they've got weakening economies. They need to engage more so in the currency wars that are happening and being led by Trump, but they have very limited ability to respond because monetary policy is exhausted. So, they can do a little bit more QE, they could change collateral lines, they could do tweaks at the margin, but it's not going to be large scale. what they need to do is to have fiscal stimulus. And the narrative in the US about MMT has gone completely mainstream now. So I'm no doubt that it's coming. It's just a question of when and how. And I think that will be when monetary policy has exhausted itself in the US. And I expect interest rates to be cut from 2.5% to 0 sometime by the end of next year, and the baton to be passed at that point. And that will get increased talk and rhetoric around this as we come into the US presidential election. But at its core, the premise of MMT is really quite compelling, and it centers around this whole ability of the government to use up spare capacity in the underlying economy, and it works for economies which have their own currency and issue debt in their own currency. And I look around Australia, which has a massive amount of underemployment of labour and a lot of jobs that could need filling. And I question, why would it be such a bad thing for the government to employ those people on short-term contracts to clean parks, clean up graffiti, do short-term jobs that would benefit the whole society as a whole and add to the productive capital? I mean, I don't think that would probably be a problem. The problem with MMT is effectively you're giving the license to a government to pump fiscal spending and stimulus into an economy until it uses up its spare capacity. And when you know it's used up its spare capacity is when inflation starts picking up. And that's when the government is supposed to take its foot off the accelerator and gently tap on the brakes. But the problem is, as we know, is that relying on governments to do that is probably a dangerous thing. And therefore, I get worried about MMT being pushed to its limits and beyond, and therefore resulting in an inflationary regime at some point in the future.
Okay. So what are the risks in the market right now that you believe people are not paying attention to?
I think it's around the slowing of global growth. The narrative in the markets right now is that interest rates have fallen, and these interest rate falls we've seen in terms of bond yields, and the upcoming interest rate cuts we're going to see from central banks across the world are going to be supportive of growth. And that means that growth levels are going to bounce back, and these are effectively insurance rate cuts, and that we'll see global growth stabilize these levels or pick up. I'm in the view that global growth is slowing. Trade wars are having an impact. Global trade is slowing, and generally we'll see a slowdown in global growth, and that necessitates further rallies in bond yields. And at some point, this slowing of growth will start feeding into real economy corporate data. And we know that the US corporate sector is as levered as it's ever been in history. And that's something I do worry about.
Okay, cool. And do you think people should own gold? What are your views on gold?
Yeah, I like gold on a structural basis, because if you believe, as I do, that interest rates across the world are coming to 0, but that's not going to be enough, and then there's going to be a handover from monetary policy to fiscal policy. Well, in that environment, the whole questioning, there's a lot of questions asked about the fiat currency system, and so gold as an established store of value. So I think that having some exposure to gold in your portfolio is a prudent thing. But I think having some exposure to cryptocurrencies as well, but I don't know which cryptocurrencies are going to be the beneficiary, because, with the new proposed currency coming in from Facebook and the proposed legislation the US is looking at, I don't know which. You can make a strong argument that Facebook Libra currency is going to supersede Bitcoin, but it might not be allowed to come to fruition. So there's a number of questions. I do know that you need, if possible, to diversify away from financial assets. And I think real assets and gold and some kind of crypto exposure is a good thing.
Cool. And moving on to Australia. Australia has been doing well for over 2 decades now, uninterrupted growth every year for 25 or 26 years. And property has been a good investment during this period. But some say there's a bubble in the sector. Do you agree?
It's difficult because, living in Australia, you don't realize, if you don't live in Australia, you don't realize how focused the entire economy is on the property market. It has been an incredibly good, strongly performing asset and a great store of value. It tends not to fall in Australia. We grow out of our overvaluations by sideways pricing, and the property price growth is supported by large immigration. And so you've always got this need to develop new properties and house prices to move on the back of the immigration flows. I do worry, though, that the size of the debt levels we're having and the fact we haven't had a recession for, as you mentioned, a very long time in Australia do make us a little more susceptible to a property slowdown. I had expected property to fall. I'm not sure, and as convinced as the consensus and the market is that a 10% fall in Sydney is sufficient and the valuations are now compelling again. And we've seen auction clearance rates pick up, and on the back of interest rate cuts from the RBA plus the fiscal stimulus from the government. But I still think that the savings rate build-up that we have in front of us will continue to pressure property prices, and I personally think they're more likely to go down over the next year than rise.
Okay. And in terms of trade war, the President Trump and President for Life Xi Jinping are engaged in a trade war now. What do you think will be the most likely outcome of this trading war, and what impact will it have on the markets?
I think it's a fundamental reset of the international trading system. For the last 30, 40 years, we've been in a world that's seen increasing globalization, and now we're beginning to roll that back. So the US companies are looking to have to onshore again, which is a massive endeavor for them to do so. And they're trying to circumvent companies. They're trying to circumvent, for example, China going to Vietnam and exporting through there. So there's a complete reset coming on that I don't think will be solved by just one trade deal. I think this is a generational shift that's happening, and the countries that sit in the middle will be ultimately forced to choose between alliances with the US and alliances with China. And I think we've only started that process. And ultimately, it has to be quite disruptive for world trade and global GDP growth.
Okay. Do you think the presidents are trying to resolve the whole thing at once? Not only the trade war, but the South China Sea problems, the Korean issue, and everything at once? And they're throwing it all at the trade war account?
I think the problem is they both have very limited maneuver. I mean, the stance that Trump has taken with China is the first bipartisan issue that's gained a lot of support. So it makes no sense for him to pull back now. And there is a prevailing feeling within the US that they have been cheated for a number of years, and that but within China's playing a long game, and so it feels it can wait out the US. So I don't expect there to be any material softening in the stance from either side over the medium term.
Okay. In regards to Europe, do you see problems intensifying this year and next? I mean, there's no shortage of risks there, right? I mean, Brexit, Spanish and Italian banks, Greece that is on and off.
We could spend hours talking about all the problems Europe have. I mean, ultimately, there's a couple of things that we need to focus on here. One, that European growth is largely a derivative of Chinese growth now. And that's because the largest driver of the change of European growth is German exports, and they largely go out to Asia and China. And obviously, as China is importing less, the slowdown that we've seen in Europe has been unusually for Europe centered in Germany, and Germany suffering more than other countries. Now, until we get a situation where Europe can focus on its own domestic demand and consumption, we're going to continue to have this problem. But it's a very difficult situation to do so when you have all these large fiscal deficits and pooling, et cetera, these questions. And I think that there's a recognition that the system is fundamentally broken and can't move forward. And I think that's the reason why Lagarde was appointed to the ECB after coming from the IMF, where she's a negotiator. And there's a lot of things that need to be cleaned up in Europe. And the banking system, as you mentioned, is one of the key ones. So I think at some point, the whole banking system needs to be cleaned up. Good banks, bad banks, maybe a nationalisation of banks, maybe a wipe out of shareholder capital, whatever it might be. But there needs to be some resolution to the banking problems in Europe before we can start pooling debts and growing out of this crisis. But I think this is going to be a long, drawn-out problem that we deal with over the next 5 to 10 years, and ultimately will bring low growth over that period as well. Okay.
So given everything we discussed, how would one position his or her portfolio to profit from the outcomes you mentioned?
That's a good question. I think a diversified portfolio is obviously the key thing here. I have a strong preference to favour bonds because my belief, as I've mentioned, is the world economy is slowing, interest rates are coming down. And while ultimately the world and central banks will run out of monetary policy ability to move rates, they've still got a lot to go. For example, the US has still got 2.5% to cut rates. So that's a material return, return your investment by buying bonds. So I like being overweight bonds here, really predominantly in the economies which have the willingness and the ability to cut rates, which are the US, Australia, New Zealand. I think you need to be underweight or cautious of credit bonds. While they've been performing very well, I worry significantly about the size of the market, the leverage that exists in the market, and the vulnerability to the corporate sector when the inevitable slowing in the US economy broadens out. And I get worries about the profit cycle and the ability to support those high levels of debt.
Okay. Now, Vimal, once again, many thanks for coming to this program and sharing your insights with us. It's been a pleasure to talk to you. And I will say to our listeners that if they ever have a chance to listen to one of your speeches, don't miss it. They are well worth it.
Thank you. Thank you. And I appreciate you having me on today.
A pleasure. Thank you.
If you like this podcast, feel free to forward it to your friends and colleagues. We appreciate your time, support, and your feedback. You can follow Marcelo Lopez on Twitter at MALopez1975. The information presented here is not investment advice and should not be taken as such. You should do your own due diligence and consult with your financial advisor before doing anything suggested or mentioned in this podcast. L2 Capital and its partners will not be liable for any losses that occur in doing whatever is discussed in this podcast.